Hello everyone, welcome to the market opening bell for Friday, May 8th, your 10-minute guide to the stock market. Reports indicate that the US and Iran have reached an agreement to gradually reopen the Strait of Hormuz in exchange for the US easing its naval blockade. Hong Kong stocks rose alongside positive overseas sentiment. The Hang Seng Index opened 317 points higher, extended gains during the session, and hit an intraday high of 26,669, up 455 points at one point. It closed at 26,626, up 412 points or 1.6%. The X-share index closed at 8,919, up 118 points or 1.4%. The Hang Seng Tech Index closed at 5,121, up 151 points or 3.1%. Total market turnover reached 312.4 billion Hong Kong dollars. Southbound stock connect funds recorded a net outflow of 4.797 billion Hong Kong dollars, marking the second consecutive day of net selling. Key flows included net buying SMIC at 808 million, net selling Tencent 2.739 billion, Meituan 690 million, CINEX 517 million, Hong Semiconductor 418 million, Alibaba 410 million, Xiaomi 122 million. Statistics show Southbound funds have net bought SMIC for 3 consecutive days, totaling 2.381 billion. They have net sold Alibaba for 10 consecutive days, totaling 5.273 billion, and Tencent for 7 consecutive days, totaling 8.856 billion. Notably, selling pressure on Tencent intensified significantly over the past 2 trading days, with net outflows of 5.136 billion. Technically, the Hang Seng Index formed a wide 305-point bullish gap on the daily chart yesterday, between 26,213 and 26,518 points. A short-term pullback to partially fill this gap is possible. After consolidation, a break above 26,700 could open the way toward 27,000. The 3 major A-share indexes opened higher and trended upward with fluctuations. The Shenzhen Component Index continued to set new highs in over 5 years, while the ChiNext Index hit fresh highs in nearly 11 years. Shanghai and Shenzhen turnover exceeded 3.1 trillion yen. The Shanghai Composite closed at 4,180, up 19 points or 0.5%. The Shenzhen Component closed at 15,641, up 182 points or 1.2%. The ChiNext Index closed at 3,833, up 54 points or 1.5%. The renminbi central parity rate against the US dollar was set at 6.8487, up 75 pips from the previous day, again hitting a new high since March 24, 2023. The offshore renminbi broke above 6.8, reaching as high as 6.7965 against the US dollar, the strongest level since February 2023. US President Trump stated that he had a very good dialogue with Iran over the past 24 hours. He expressed optimism about reaching an agreement with Iran before his planned trip to China next week, believing the chance of ending the war is very high. Under the deal, the US would obtain enriched uranium from Iran. One of the core objectives of any US military action against Iran was to prevent it from developing nuclear weapons. Iran has not yet handed over more than 900 pounds of highly enriched uranium. Coal stocks continue to trend weakly. The direct trigger was easing geopolitical tensions as the likelihood of US-Iran negotiations increased. Market anxiety eased significantly. This led to heavy selling in energy sectors that had relied on the war narrative. Funds that had previously sought safe haven in coal began flowing back into offensive sectors such as technology. Chinese media reported that renowned investor Duan Yongping posted on social media that he had sold all his shares in China's Shenhua and switched into PopMart. He jokingly added, "Shenhua is a very good company. Our investment has delivered excellent returns. Thank you. We may come back in the future." PopMart rose 3.8%. According to reports, after selling his remaining 49% stake in Vodafone 3 for £4.3 billion, CK Hutchison is considering further disposal of his telecom assets amid intensifying competition and high costs in the sector. However, sources say CK Hutchison is not in a hurry to close any deal quickly and aims to maximize asset value. Listing the telecom assets is also one of the options being considered, depending on market conditions. CK Hutchison currently operates telecom businesses in several European markets, including Italy, Sweden, and Denmark, and holds controlling stakes in Hutchison Telecom Hong Kong. Xiaomi's first range extender SUV will no longer use the main Xiaomi brand. It will launch under a new independent sub-brand called Xuntian Sky Nomad in the second half of the year. The Xuntian brand is positioned between the main Xiaomi brand and will focus on the family, long-distance, and outdoor travel market. It plans three range extender SUVs: Kunlun 10, Kunlun 20, and Kunlun 30. The Kunlun entry will be the first model launched and will be the highest positioned. Additionally, the brand plans an elevating rooftop camper van, codenamed Isle of Man, which will sit above the Kunlun series as a premium product line. Uni-President China releases unaudited first quarter 2026 results. The company continued its growth momentum from 2025 with further improved profitability. Q1 unaudited after-tax profit reached 737 million yuan, up 22.5% year-on-year. The profit growth rate was significantly higher than previous levels. For instance, full year 2025 profit growth was only 10.9%, showing progress in cost control and product mix optimization. Melco SJM Holdings announced its key business indicators for Q1 2026 affected by the closure of satellite casinos and market competition. Overall performance showed revenue decline, swing to loss, but improved margins. Following the satellite casino closures, market share dropped from 13.1% in 2024 to approximately 11.9%. Q1 gaming net revenue fell to $5.364 billion from $6.949 billion in Q1 2025. Adjusted EBITDA was $917 million versus $958 million previously. The adjusted EBITDA margin improved to 15.5% from 12.8%, reflecting better operational efficiency. The company recorded an attributable loss of $62 million compared with the $31 million profit in Q1 2025.
Zhou Liufu 06168 released its Q1 operational summary. Revenue reached RMB 1.273 billion, benefiting from strong gross profit growth, approx plus 50% from online channels of the Zhou Liufu and Miaoji brands. Profitability indicators improved further. Net profit attributable to shareholders rose approximately 29%. Investors focus on developments regarding a possible US-Iran peace agreement. Oil prices rose, causing the three major US indices to end their two-day winning streak. The VIX fear gauge fell 0.31 points or 1.8% to 17.08. The S&P 500 closed down 0.4% at 7,337. The Nasdaq fell 0.1% to 25,806. The Dow dropped 0.6% to 49,597. The Nasdaq China Golden Dragon Index declined 99 points or 1.4% to 7,027. All sectors fell except communications services and technology. Materials and energy led the declines. Tesla, TSLA, US delivered a combined 79,478 Model 3 and Model Y vehicles from its Shanghai factory in April, the sixth consecutive month of year-on-year growth, though down 7.2% month-on-month. British chip designer ARM, US reported Q4 revenue ended March up 20% to $1.49 billion, with EPS of $0.6, both beating expectations. ARM noted weakness in the smartphone sector, its main revenue source, but expects AI data center growth to offset the decline. It guided Q1 ended June revenue at approximately $1.26 billion, market consensus $1.25 billion, and adjusted EPS at $0.4 after specific items, above expectations. Warner Brothers Discovery Warner Brothers Discovery WBD US reported Q1 total revenue down 1% year-on-year to $8.893 billion, in line with expectations. Due to a $2.8 billion breakup fee related to Netflix, the quarterly loss widened to $2.916 billion versus a $453 million loss last year. Basic loss per share was $1.17, far worse than the expected 9-cent loss. The breakup fee was paid by Paramount Skydance as part of their $110 billion merger, but recorded by WBD. Post-merger, the combined entity will have 220 million streaming subscribers, strengthening its position against Netflix and Disney. The company said the international rollout of HBO Max was largely completed in Q1. Streaming revenue rose 9% year-on-year to $2.89 billion, beating expectations of 7.6% growth. HBO Max remains key to future growth. Ride-hailing and delivery platform Uber UFER reported Q1 revenue up 14.5% to $13.203 billion, missing estimates due to weather, geopolitical tensions, and higher fuel costs. However, delivery and freight segments outperformed, with freight returning to growth for the first time in nearly 2 years. Total bookings rose 21% at constant currency. Non-GAAP adjusted EPS reached $0.72, up 44% year-on-year and above the expected $0.7. For Q2 2026, Uber expects total bookings of $56.25 57.75 billion, 18.22% growth at constant currency, beating consensus of $56.07 billion and adjusted EPS of $0.78082 above consensus of $0.79. McDonald's MCD US reported Q1 results that beat expectations. Comparable sales rebounded year-on-year and exceeded estimates, though the company described the operating environment as challenging. Adjusted EPS was $2.83 vs $2.67 last year and expected $2.74. Revenue rose 9% to $6.52 billion, above the expected $6.47 billion. Comparable sales grew 3.8%, reversing last year's 1% decline and slightly above the expected 3.7%. Shake Shack US reported Q1 results that missed expectations due to weather, sending shares down 28%. The company maintained its 2026 revenue guidance of $1.6-1.7 billion and expects low single-digit same-store sales growth. Analysts forecast revenue of $1.66 billion and 3% same-store growth. For the week ended May 2, initial jobless claims rose by 10,000 to 200,000. U.S. layoffs increased in April, the third highest for the period since 2009. According to Challenger, Gray, and Christmas, companies planned 83,387 job cuts in April, up from 60,620 in just March, but below 105,441 last year. The technology sector led with 33,361 cuts, primarily due to increased AI adoption. Hiring plans announced in April totaled only 10,049, down from 32,826 in just March and 16,191 last year. April non-farm payroll data will be released today, with forecasts at plus 65,000 jobs, lower than the previous month's plus 178,000.
Our stock pick today is FORTIOR, stock code 1304. FORTIOR is a chip design company specializing in the design and development of brushless DC (BLDC) motor drive control chips. The group has established a strong market position in the BLDC motor, main control and drive chip industry. It's China's first chip design company focused exclusively on BLDC motor drive control chips, and the only Chinese company among the top 5 players in this market. Based on 2025 revenue from BLDC motor drive control products in the Chinese market, the group ranks 4th among all BLDC motor drive control product companies in China with a market share of 5.7%. It is also the largest domestic company in China's BLDC motor drive control product market by 2025 revenue. A BLDC motor is a brushless motor driven by electronic commutation. It uses electronic commutation to change the magnetic field and drive the rotor to rotate. Compared with traditional motors, BLDC motors offer advantages such as high efficiency, low power consumption, high control precision, and low noise, leading to widespread use across various applications. The group's products are designed to maximize the performance advantages of BLDC motors, enabling high efficiency, low noise, and high precision operation. Its product portfolio includes MCU, ASIC, HFIC, MOSFET, and IPM, all core components of a typical BLDC motor drive control system. The MCU ASIC serves as the motor main control chip responsible for receiving electronic signals, executing motor drive architecture algorithms, and generating precise control instructions. The HFIC acts as the drive chip, providing high-low voltage isolation and enhancing drive capabilities, allowing the MCU ASIC to effectively drive MOSFET devices. The MOSFET, under the control of the MCU ASIC and driven by the HFIC, generates specific electromagnetic fields to operate the motor, enabling efficient MLDC motor performance. The group's products are used in BLDC motors, which are widely applied in multiple downstream sectors, including small household appliances, white goods, power tools, sports and mobility, industrial applications, automotive, and humanoid robotics. Leveraging its strong R&D capabilities, reliable product quality, and high cost-performance ratio, the group has built an extensive base of high-quality end clients In recent years, its revenue has grown rapidly from 173 million yuan in 2023 to 600 million yuan in 2024 and further to 773 million in 2025. In the first quarter of this year, the group achieved revenue of 250 million yuan, up 46.2% year-on-year, while net profit attributable to shareholders reached 88.26 million yuan, representing 75.09% growth, driven by the rising penetration rate of BLDC motors in downstream industries and the advantages of BLDC motor main control and drive chips. The global BLDC motor main control and drive chip market grew rapidly from 19.11 billion yuan in 2021 to 36.12 billion yuan in 2025, at a compound annual growth rate of 17.2%. Is expected to expand from 42.5 billion yuan in 2026 to 78.66 billion yuan in 2030, with a CAGR of 16.6%. This presents significant growth opportunities for the group. Recommendation: buying price $134, target price $150, stop loss $127. I do not hold the above stock.